Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at equities, and E-minis continue to climb, albeit a little slower than we've seen in the last week or so. Hovering at year-to-date midpoint, right around 2,700. We've a level we got as high as I think March today, but we pulled back slightly. There's a lot of things going on right now in the market, and equities kind of regenerating some upside momentum may be limited here as we look at oil prices making all-time highs. We look at treasury yields unable to continue to climb, so they're coming off. But ultimately, we're just still in that comfort zone between what we'll say is going to be somewhere between 2,600 and 2,800. That's a very wide range. However, 2,600 is kind of that low-level line in the sand, and just above it is the 200-day moving average, and that's a level that the market has yet to really spend any sustained period of time below. So the 200-day moving average is your first support. 2,600 is kind of that oops level you don't want to be below. We are well away from that right now, but as we've seen in 2018, equity prices can move very volatilely, and we can see big swings, but we didn't see that today. We haven't seen that in a while, and if you look at the VIX index as an indication of where things are going, boy, I think yesterday we talked about the VIX index trading below 14 3 times since February, make it 4 today, and it's only continuing to trend lower. So volatility trending lower isn't necessarily a sign that everything's okay. Volatility gets bid because you're perhaps wanting to buy insurance for your portfolio, and the only reason you don't buy insurance is you don't want it or you don't need it. And maybe there's been some exiting of longs. Perhaps there's been some position squaring that has caused maybe the fear to go away, or ultimately they believe that the Fed won't let the equity markets collapse, and that sort of that Greenspan, Bernanke, Yellen, now Powell put is in place. But ultimately, market volatility in the equities is very low considering all that is going on. And if you look at today's data, CPI came in a little tepid. What that really tells you is that the Fed can't put their foot on the gas if they want to raise rates a fourth time without some help. Right now we're priced for a rate hike in June. That'll be number 2 for the year. And there's one more additional rate hike priced into 2018. That would be 3. The equity markets really aren't concerned with 2 or 3 rate hikes through the end of the year. I think if we get closer to 3% on the effective funds rate, which is a long way away, then you might start seeing some money exit. But right now, equities are still using this immensely low effective rate as the benchmark, and right now it doesn't seem to be changing very quickly. So equities will remain sort of in that comfort zone, but with a very slight bullish momentum here as we took a break today from the extreme moves higher. We have a lot going on in the Middle East that could change things in equities very, very quickly. This is Todd Colvin coming to you from the floor of the CME Group.